Everybody thinks you buy a house, you get $8 grand. That's what everybody thinks about first-time homebuyers tax credit, and that might be true, but not necessarily that simple. So, if you will bear with me, there's 3 different versions of this bill, and all 3 of them may apply to any one of your clients. So we have to have a little bit of a history lesson before we can talk about the bill as it stands today. The original version is for houses that were bought in 2008. So most people who have bought a house have already done this. It wasn't that great a deal. It was a $7,500 credit, maximum 10% of your purchase price. So assuming you were buying a house more than $75,000, you were getting the credit. It was repayable to the government over 15 years. So it wasn't really a tax credit, it was really an interest-free loan from the government. So nice, but not great.
Easy.
Yeah, and they don't advertise that piece of it. They say buy a house.
So you had to pay them back?
You had to pay them back,
Then
yes.
I think that they should disclose that.
They should advertise it more than they advertise the tax credit, yes, and they don't. But that's the old one, so we don't have to worry about that one anymore.
Yeah, God forbid we do something like that.
It's a good thing we didn't buy then.
Good thing, because then version 2 came along. For homes, but this was the second extension of the act, and this was all part of Obama's first big tax act. The second credit, which was called the revised first-time home buyers tax credit, was for homes that were originally, the dates were January 1st of 09 to December something of 09, and then November he signed another one. So now the effective date on that one is November 6th. So this version applies to houses that were bought from January 1st of 09 through December 6th of 2009. This raised the credit to $8,000, again, maximum 10% of your purchase price. And it took away the recapture provision. So it is not something that at that point has to be repaid. It is truly a tax credit in version 2. It's a refundable tax credit. So if you'd already filed your tax return and then you bought a house and went back and amended it, you got a check for $8,000. If you had not yet filed your tax return and you had tax due of $2,000, you'd get that $2,000 back. You'd get the net back up to the $8,000. Version 2, they addressed home construction. Version 1 left a lot of questions open. Version 2, they addressed homes being constructed. The date of purchase for a home that was being constructed for purposes of the tax credit is the date the homeowners moved in, not the date they actually signed the purchase agreement. It is an $8,000 tax credit for everybody, including a single person and a married joint. Usually you see those things cut in half. A single person would get 4. Not in this case. Anybody gets 8 except if you're married filing single. Then you only are entitled to $4,000. They're trying to prevent people from filing single just to get this credit. Like I said, they took away the mandatory payback. What they did add, though, is if you did get a credit and you sold that house within a 36-month period of the date of purchase, you had to pay back, to the extent that you had gain on the sale, you had to pay back that much of the credit. And that still exists today. So if you get an $8,000 tax credit today, and in 3 months you sell that, 3 years, you sell that house and you have a $10,000 gain, you've got to pay the government back the entire $8,000. If you have a $2,000 gain, you have to pay the government back $2,000. If you have a gain in this market, God bless you. 3 years in 1 day. Don't close. Yeah, exactly. Exactly. Yeah. There are some other exceptions to this rule. There are so many what-ifs, and I will say right now, like I said, I had 3 hours of CPE on this, so we covered all sorts of things. Heterosexual couples, not heterosexual. If you have a for instance or a specific case in mind that I don't talk about, please feel free to call me or email me, because there are a lot of what-ifs. What if a spouse should die after the purchase? What if you've inherited the house? What if you are a mother and a daughter? And each of those scenarios has a different set of rules to apply to it. I'm not going to bore you with all of that tonight. What didn't change, these first 2 versions were very similar in a lot of areas, and that's the rest of the first page. The credit was limited to 10% of the purchase price, $7,500 first, then $8,000. It was refundable. It is subject to your adjusted gross income. So there are limits. If you are a, let's see, single person, married, filing separate, or a head of household, if you were making $90,000 or more, you were getting 0 credit. The IRS also didn't publicize this a whole lot. If you were a married couple and your AGI was over 170, you got 0. So you really have to sort of look at where your situation stands from your income perspective before you can sell, before you go out and say you can get an $8,000 tax credit. The biggie in versions 1 and 2 and what's new today that you've all heard of, the biggie for 1 and 2 was it was only for first-time home buyers, meaning you had to have not had a principal residence for the past 3 years in the United States. If you'd been living overseas for the last 3 years and had a principal residence over there, doesn't matter, in the U.S. So that was the big change in the current version, is they took that out. Let's see, you couldn't buy it from a related party, so you couldn't buy it from your husband, you couldn't buy it from your mom, you couldn't buy it from an aunt or an uncle. Those things were all no good. The biggest thing with version 1 and 2 and 3 is when to report this on your tax return, because you do have choices. If you bought a house in 2008, it got reported in 2008, period. If you bought a house in 2009, you could go back and amend your 2009 tax return and take the credit. I'm sorry, your 2008 tax return and take the credit, or you could take it on your 2009. And that's where the adjusted gross income factor comes in, because if you have a really good year in 09, you want to go back and amend 08, vice versa. You know, look at where your income is higher and take it in the other year. If you buy a house in 2010, you can do the same thing. You can report it in 2010, or you can go back and put it on your 09 return, which I doubt anyone has filed yet. If you have filed it, you can amend it. Yeah, so that's that. So now the one that's in place today, the current version, which is actually a new tax law, the home buyers something, 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 that was just signed on November 6th. This one's pretty good. You know, every time more questions were asked, they kept revising the bill, which is good. It's sort of been a growing bill. The $8,000, this applies to homes that were purchased after November 6th of 2009 and before April 30th of 2010, or if you had a signed contract and you closed before June 30th. So there was a little more time on this one. They were trying to help people that were scrambling to get closings completed.
And purchase is the closing itself. It's not the day you sign the contract. It's
Correct.
the actual day the title transfer.
Exactly, except with this law, you have to close, if you have a signed contract by April 30th, you do have until June 30th
But
to close.
the beginning point, if you put, you went into contract on November 5th,
Mhm.
and you purchased it, you actually
closed, it's the
Okay.
closing date,
Right.
yes, yes. So the $8,000 credit was extended, and they brought in a new tax credit, the $6,500 credit for existing home buyers. The rules, and that one is cut in half if you're married filing separate as well. This was for, well, again, 10% of the purchase price up to a maximum of $6,500. And this is for people who had current primary residences and were buying a new home, making it their new primary residence. You cannot, and I can't tell you how many times I've gotten this phone call, you cannot use this for a vacation home or a second home. You must make it your primary residence. And in order to do that, I mean, just as a general rule of thumb, because I know up here we get a lot of people that move to Florida, or they buy a house in Florida and they're snowbirds and they want to change their residency. Change your voter registration, change your car registration, and all of your mail has to go to the property that is your primary residence. So that would apply to this rule too. You qualify only if you have had your house that you're selling, or no longer going to use as your primary residence. You don't necessarily have to sell it. You have to have lived in it for 5 of the last 8 years, and it has to have been your primary residence for 5 of the last 8 years. If you've owned your house for less than 5 years, forget it. You don't qualify. You just won't meet the 5 out of 8 rule, so that's the easy way to remember it. Let's see. It also, this bill also increased the AGI, so higher income people can now take advantage of home purchases after November 6, 2009. There's a lot of dates on these, so forgive me. But they raised it to $245,000 from $170,000. So that's a big jump. That's really going to bring in a whole new crop of people that will benefit from this. This actually works really well. A lot of people think you have to move up. There used to be that old rule on the sale of your house. You had to buy a bigger house to exclude the gain. This does not have anything like that attached to it. This is a great rule for people who are downsizing. For a lot of, older people, families are off, kids are off to college, they're moving their primary residence to a smaller house. They can take advantage of this credit, especially if their AGI, if it's under that 240 or whatever number I gave you, 245. As long as they've been in that house for 5 of the last 8 years and they're buying a new principal residence, doesn't matter if it's across the street or across the country, they qualify for this.